Which of the following best explains why mutual funds are considered a pass-through vehicle for investors? Here are your options. A. Mutual funds do not retain profits but distribute all gains to fund managers. B. Investors in mutual funds directly own the stocks and bonds purchased by the fund. C. Mutual funds pass on both risks and returns to investors without guaranteeing profits. Or D. Investors can buy and sell mutual fund units directly from stock exchanges. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. A mutual fund does not guarantee returns, but instead passes both the risks and gains of its investments to the unit holders. Why do mutual funds generally trade at a discount to their NAV in the secondary market? Here are your options. A. Because the fund manager holds a significant percentage of units. B. Due to the high expense ratio associated with mutual funds. C. Mutual funds are illiquid, making it difficult for buyers to sell them later. Or D. Buyers in the secondary market have multiple investment options, giving them better bargaining power. Take a moment to pause the video and decide. The correct answer is Option D. Let's see why. Buyers of close-ended mutual funds in the secondary market have more alternatives, allowing them to negotiate lower prices than the NAV. What happens if a close-ended fund does not get listed on a stock exchange? Here are your options. A. Investors cannot redeem their units before maturity. B. The fund is automatically converted into an open-ended fund. C. The fund manager must buy back all units at NAV. Or D. SEBI penalizes the fund for non-compliance. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. Close-ended funds must be listed to offer liquidity. Otherwise, investors must wait until maturity to redeem. A mutual fund scheme with an investment objective of high liquidity would most likely invest in. Here are your options. A. Equity shares of large cap companies. B. Corporate bonds with 10+ years maturity. C. Overnight securities with a maturity of 1 business day. Or D. Real estate investment trusts. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. A scheme prioritizing liquidity invests in instruments like overnight securities, which mature daily. Why do mutual funds need to mark-to-market (MTM) their holdings daily? Here are your options. A. To ensure that all investors receive the same NAV regardless of market fluctuations. B. To adjust the NAV based on the latest market prices of securities in the portfolio. C. To maintain a constant NAV throughout the day. Or D. To avoid tax implications for the investors. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. MTM updates NAV daily by reflecting the latest market value of the mutual fund's holdings,